Hello there, Kevin Dooling with KDI, coming with you with your Saturday night technical update. I wanted to go over the three grains, look at what's developing in all three, because it's interesting to me because they all three have a similar properties despite differing fundamentals, differing world fundamentals, differing local fundamentals. So I thought it'd be important to just kind of walk you through that real quick. This shouldn't take a long time. I'm sorry about the video thing. After the computer went through the update, it changed the software, and instead of being able to just flip it over to the display, I have to manually do it. So I apologize for that, but let's see if I can get that done. There's display capture. There it is. Add. Okay, so let's start with. I guess we all know the fundamentals of corn, so let's talk corn first. Okay, this is your 4-year corn market. As you can see, so far, despite the 177 bushel yield that USDA used last week, with an increase in stocks, mind you, only 120 million bushels or so, despite the 177 bushel yield. To me, that tells you what demand is doing. It is not going to take a very large hiccup in corn yields to create a pretty big cut in U.S. carryout. Plus, everywhere else in the world has very tight corn supplies other than China, and I don't think we'd even believe the Chinese numbers. Somebody major just bought 30 million bushels last week, which I assume was China as well. So if we look at this, I talked about in my weekly report, I talked about peak bearishness and felt that we had reached that this week in corn, that with 1.3 billion hedge funds short, plus just the attitude that the market will never rally again, along with last year had lots of weather hiccups, and yet we still realized a record yield, so to speak. Maybe what kind of weather is it going to take to drop the yield? I don't know. So if this chart's correct, and I'm going to be, like I say, we're just talking technicals here. The true technician doesn't care what the fundamentals are. It doesn't care what market it is. They don't care what the yield is, if it's even a grain. They just look at the chart patterns and can pick out things. So it's an important tool to be able to use. I'm not saying divorce fundamentals. I'm saying do the fundamentals and technicals line up together. So according to this, the primary low so far was made in the middle of 2016. Okay, or I should say fall of 2016. That has been the primary low in the long-term charts. In wave terms, we can call this wave 1 up, so to speak, and then we have a wave 2 down. So if we've reached peak bearishness, so they say psychologically, peak bearishness is at the bottom of the second wave down. So this downstrand that my cursor is, that is wave 2 down. This would be your most bearish area, okay? Now this wave can sag off some more, we can get more bearish, but so it doesn't have to turn around yet. But the odds are, like I say, given the market action this past week with a decent rally after last week's report, we have strong basis in many locations. Some areas are still behind, but from my standpoint, longer term, this should be supportive. If we can hold above this low, if we can make this thing catch in here, and we simply don't have the farmers wanting to sell 350 corn, then this market can move higher. If there's something to spook them, if there's a weather problem in South America or whatever, you've got a billion bushel fund position, hedge fund position, 1.3, I think, which easily propel us over this $4 mark. So watch that. I mean, I was expecting a 30-40 cent move regardless, sometime in the next 4 months, but I was telling the corn grower, it's like, look, wheat's got a better set of fundamentals and can move farther than that. So why not anything you sell in corn? Why not switch that over to wheat? So you can own the options for whatever price you like. So I thought that was a better move. So let's go down and let's compare that to wheat now. It has a totally different chart look to it. This is your, yep, this is Chicago wheat 5-year market. It's 5-year chart. I don't have a label on there, but knowing the price, that's what it is, March wheat. So continual. So if you recall, about in here I expected long-term lows, multi-year lows that would translate into a multi-year bull market, just based on lack of acreage, based on increasing demand, and based on how long we'd been in this downtrend. I mean, we were in this downtrend since 2012. If it wasn't for the shortage of corn in 2012, it probably would be even longer yet. So when I look at this, same as corn, we made the primary low in 2016. It came a little later than I expected. I thought that was the primary low. Chart pattern wise, this looks pretty good. Has that saucer look to it that I like. Thought that was the primary low. It wasn't. We had to crank down a little farther. Now what's interesting, the market started to move up and then we were hit with massive Russian production. Okay, this is 2016 crop. We were hit with the massive Russian production, which brought us to here. We then caught and started to stabilize, and now right here is when the Australian number came out. It was when they bumped it from 30 to 35 million metric tons. This is the Australian wheat number. That crashed the market, and that set the primary low. You know, it's interesting. We go clear out to here, another, what is this, a year and a half away to today, and USDA and the bears eliminate the 5 million metric tons. So, you know, was this move even necessary? Because it was based on information that was false. It was either the crop was smaller than they thought, or B, the demand was higher than they thought. Either way, we lost because we didn't get to recognize that on paper until today. So that's extremely frustrating. It makes you wonder what other numbers are going to be historically revised in the future. But anyway, speaking technically, this is similar to corn. We have the wave one up, which started about the same time. Okay, we made the same move up, except farther because we had more stories going. We had the snow event. We had the northern plains drought out, resulting in that spike up. This made your wave one up. And now if you're a trend line guy on the technical stuff, you can draw the trend line on my cursor, you know, right across these highs, and it comes down through here. We are above that. All these are above that. So we cross that long-term trend line. We are higher than that. That is significant. So we have the wave one up. The wave two down is next, which is the most bearish time. This is the most bearish psychology we can get right in this time frame. You get the feeling it's never going to move. And so, just like corn, if we can catch and hold in this area and start to move north, that is going to be extremely significant from a wave perspective, because this will lead into the strongest and longest wave impulsive up move. Okay, so it will have, you know, if it's true to form and it's accurate, it will go much farther than this wave. So this was just wave one, so we'll have a wave three that goes higher than that. Time frame, like I say, it's due to start any day, but it could stretch. You know, we could stretch this wave two clear out to, oh, I suppose March or something like that. But to me, very similar to corn, the price action this last week was fairly impressive, at least in the corn market. wheat got hit the hardest on Friday, but it was also the only market that rallied up into the report. So now let's look at who's next. We'll look at soybeans real quick. We'll see if we can draw any parallels with soy, and then flip over to Minneapolis. But okay, here's your soybean market. A little different structure than beans and corn, or than wheat and corn, but same pattern, right? It's just a little more delayed. So according to this one, instead of making the primary low in July of 16, or should I say fall of 16, like wheat and corn did, this one made a primary low in the first of 2016 in January or December of 15. Made an impulsive move up and has since just kind of ground lower, but we have not taken out this low. So if we do take out this low and we do come down into the 8s, take out this low, it's going to look pretty ugly on the chart. And to me, it's not going to say this market's strong. What's interesting to note, last year in January, okay, here's January 17, we rallied up into the report and then started a free fall. We dropped a good $1.50, and this was all based strictly on the U.S. carryout number being 480 million bushels, is what they said in the early January quarterly report. Now the reality is, as we got into here, we started to get nervous because it's like, shoot, are we going to be 250 million bushels or 300 million bushels? Now USDA had it at 480 right here, but in reality it was 300, and so the market rallies off of that, and then has been trading South American weather and bean yields ever since. Now January, same thing applies. They have the carryout at 470 million bushels and the yield at 49. I have a hard time seeing 49. That's kind of the top end I heard from a lot of people. That was their best yields, and a lot of them had a lot of fields in the 30s and 40s, and so you average at low 40s, and so it's really hard to get a 50 bushel average out of that. So if we end up with a 45, 46 bushel average, 47, and demand starts picking back up, exports have been lagging, so they've got to start moving. We're going to be right back down into that 300 million bushel mark again for carryout. So, and that's assuming Argentina has a crop. If they don't, then we're going to go there anyway. So a little more dynamic than it appears. I like the wheat and corn charts slightly better than this one. This one's just too long and drawn out this way. This one looks like it has more of it's more apt to slip. But, like I say, if Argentina is going to get dry, then it's not going to slip. It's going to go, and then it's going to clean up the chart really nice and look better. So, lastly, I want to look at Minneapolis wheat. This one has a couple things going for it, okay? It feels like the most bearish now because we've taken most of that run up we had that started, I guess in May. We've taken most of that out, but not all of it. There's a couple things I like, and one is just the overall bowl shape of this chart. Okay, here's your primary low in early 2016, about March, I believe. And I guess it might be February, but you can see this thing is a big bowl. You see that? That is definitely an indicator of a long-term low is present and that has been made. And if you go flip over to wave terms, here's our initial wave higher. Here's our wave 2 down. Bearish psychology, but only in the futures. But if you look at cash, we don't have bearish psychology because the basis is stronger than it's been in a long time. So anyway, if we expect a wave 3 move, that would take us beyond this mark. We could see some pretty good fireworks. On the flip side, we could bleed this thing off a little longer, but this chart looks a lot stronger than the other wheats. Like I say, you compare that, you compare how far this came down from the rally, okay? You can call it, now let's just look at the May rally. Okay, we started in the mid fives and we moved over 8. All right, and then we slipped to 6. If we flip that to the Chicago chart, we started in the same place. We started at $4, we went just over 5, and we came back down below $4, even lower. So we took the other wheats, and KC looks just like this. We took the entire rally away, whereas the Minneapolis did not. Okay, so this is the most bullish wheat based on the technical factors, and given that some of the higher pro stuff's having to make its way south to blend with the low pro hard red winter, to try and make that 12% grade out of the Gulf, this is going to use bushels that probably shouldn't be used. Things are going to get tight in that market, in my opinion. It's going to buy some acres. If you look at the carry out to December, you can sell some 650 stuff, which, you know, doesn't work for me for trying to raise dark northern spring, but with the added fertilizer expense, whatnot. But the Northern Plains guys are going to take some of that compared to $3 corn and $9 beans. So anyway, that's my technical update. I don't have a whole lot else to go through. I'll look at the world wheat situation next. I'll record that and get that out to you as soon as possible as well. I just want to get you a chart so you could see what I'm looking at. And like I say, wave model wise, everything looks pretty strong. Corn looks like it could go. Beans look like it could go. Wheat looks like it could go. We need a catalyst. Not sure what that would be. We've got the hedge funds in position to where they can't sell a whole bunch more, so that's good. Just need to kickstart it. So anyway, I hope you got something out of this, and we'll flip you some world wheat charts soon. So thanks again.